What's up, everybody? Chris Servishon here. BetterWayCPA.com is the website. And today I'm going to talk to you about the 5 steps to understanding your marketing or creative agency's cash flow. In a 2018 study done by Hubspot, they identified cash flow as the number 2 barrier to growing an agency. I think a lot of times that agencies think that cash flow is like this mystical sort of thing. It's tough to understand. It's way down in the weeds. We need to avoid it, but maybe not. That's not the case. It's not that hard, I promise. And I'm going to debunk that over the course of the next few minutes. This is certainly something that we see a lot with our agency clients, and I think that this video is going to be helpful. So, the 5 steps. Know what cash flow is, obviously, right? But it's not as complicated as it's sometimes made out to be. Use accounting software, determine your cash reserve, forecast your cash flow, and then make solid decisions based on that forecast. Number 1, what is cash flow? Super simple. It is money in minus money out. And when we're talking about money, we're not talking about receivables or payables. We're talking about actual cash coming in the business. Receivables and payables, those are things that are happening in the future. We want to know actually cash coming in or going out of the business. There's 3 buckets, and then you're going to see this on your cash flow statement. I'll talk about that in a second. Number 1, cash flow from operations. That is the big kahuna of this whole thing. Cash flow from operations, how the business is actually generating or not cash. Super important. Examples of that, net income. So when you're thinking about a measurement period, maybe it's a month. What is the revenue that you drove and the cash that you receive for that revenue? And then we've got some reconciling items, accounts receivable and accounts payable. And those 2 things are opposites. Accounts payable deals with expenses, accounts receivable deals with revenue. When you think about AR, what that actually is you did a project for a client. You sent them an invoice, so the work's already done. You've earned the revenue. You're just waiting for them to pay. And maybe you're net 30, so you might wait for them for 30 days. Might be longer, might be shorter, not sure. But that cash might be received in another period. So if you do work in May and then you receive the cash in June, that cash flow should be allocated to June. You should know that the cash is going to come in the door in June. The opposite is true for payables. Those are on the expense side. Number 2, cash from investing. Most of the time we see this on the agency side with equipment, and mostly we see that being laptops. Agencies really are not capital intensive businesses. They don't require, huge pieces of equipment, generally speaking, and mostly it's just laptops, okay? But that's on the, the expense, the money outside. CDs and money markets, that would be the most common, probably, investment that an agency would make to bring cash in. You're going to receive interest on a CD or a money market. And so those are probably your most common cash from investing activities that you're going to have. And then finally, cash from financing. That's going to be cash to finance the business. So cash coming in would be taking a loan to finance the business, to provide you with some working capital perhaps, or cash coming in from a shareholder or a partner as far as a capital contribution. Those are things to finance the business. When you pay those back, if you have to pay those back in the case of a loan, that's going to be cash going out. But that's financing. The interest that gets associated with those loans, that goes in financing as well. So those are the 3 buckets. They go in your cash flow statement. Where do you find the cash flow statement? Well, you got to use accounting software, especially if you're a newer agency. You might be using just bank statements and you might be tracking things on an Excel sheet or a Google sheet. That's not the way to go. Things get missed. The data gets dirty. It's jumbled. It's all kind of all over the place. It takes time, most importantly, to put those things together. Connect your bank feed, so your bank account, your checking account, hopefully you have a separate one, your credit card account to a software like QuickBooks or Xero, put it in the bank feed, and then it's basically just, a couple of clicks, and then you've categorized your transactions, and then those transactions will feed into your P&L, which you should be reviewing on a consistent basis, and your balance sheet, which you should be looking at on a consistent basis, and then your cash flow statement, which is here. And those are the 3 buckets I just talked about. It's going to break down your cash from operations, your cash from investing, and your cash from financing in an easy way that's easily digestible. It's easy to get to, but use an accounting software. If you're not using an accounting software, you're totally missing out. I always recommend cloud-based accounting software, so QuickBooks Online versus desktop. That's a good example. There's another video that I did as far as cloud accounting, why it's awesome and why you should use it. I'm going to link that in the show notes, but definitely do check that out. Next, determine your cash reserve. Super important. You need to have between 2 and 6 months of fixed expenses in cash, in reserve, in your business at all times. That's going to allow you to scale. If you think about it, business all comes down to cash. You can't pay your mortgage without cash. You can't pay your people without cash. If you don't have enough cash, at some point people are going to stop loaning you cash and you're going to go out of business. It all comes down to cash. You need to have a cash reserve. If things go sideways, the first thing you need to go do is run through your cash reserve. Then you'll run through your line of credit, and then you'll make a decision about whether or not you still need to be in business if things get really bad. But your cash reserve is always going to be your line of defense, and it's always going to be what really truly allows you to scale. When you're thinking about bringing on new employees, you got to have that cash reserve because there's going to be an increase in wage expense, which may not come with an increase in revenue, increase in projects. Super important to have that cash reserve. There's a cash reserve calculator on our website. That's what I'm showing here. I'm going to link to it in the show notes. There's another video that I did about cash reserves. Definitely check that out as well. Okay, forecast cash flow. That's the next step. And when we're talking about forecasting cash flow, this particular template that I'm showing on the screen, it's a webinar that I did, hour long, more about cash. It's basically the final salvo on cash. There's everything about cash is in that webinar. So I'm going to link to that and definitely go check that out. But you need to be forecasting your cash flow for some period of time into the future. And even if it's a week, 2 weeks, 150 days, 3 months, whatever it is, you've got to start somewhere looking out into the future and identifying problems before they occur. If you know that your pipeline is XYZ and then on a probability adjusted basis, you know that you're going to sign this number of clients, this amount of cash is going to come into the business, that's great. If you know that you've got to hire somebody, or if you've got to pay payroll twice a month or bi-weekly or whatever it is, this amount of cash is going to go out. Your existing customers, maybe you have them on a subscription, maybe they're project-based, you're expecting that revenue to come in, that's great. But you need to know, because this is going to flag problems before they actually happen, and then you can make adjustments so that you're not caught, flat-footed. Got to forecast cash flow, and you need to be able to forecast cash flow in a way that you're going to forecast your cash reserve as well. If you don't have the cash reserve that you need and you're forecasting cash flow, at what point are you going to get to that reserve so you know when you can scale? Are you not going to get to that reserve? And if you're not going to get to that reserve, well, then you need to do something different. You either need to bring in more business, you need to raise prices, you need to sell different services, increase services to your current clients, whatever, fire people, hopefully not. Whatever it is, though, you need to understand your cash flow forecast in the context of how much cash you actually need to have in your business. And then finally, make decisions based on your forecast. Are you overstaffed or understaffed? If there's not much in the pipeline, if there's not much revenue coming in, your wage expense is super high, the cash flow is negative or just slightly positive, then maybe you're overstaffed, maybe you need to make a hard decision. Can you take a distribution? That's the whole point of why you're in business, right? I mean, we're all here for a bigger purpose. We're doing things that we love. Hopefully, we're having fun serving clients. Yes, that's awesome, but at the end of the day, your kids got to eat. So, can you take a distribution from the business? Do you need to renegotiate terms? Are there terms that you have with your clients where maybe they're not getting paid the way that you want to get paid? Do you need to put in late fees? Do you have vendors that you're paying? Well, maybe you want to negotiate those terms so you can pay a little bit slower. But if you forecast your cash flow and if you understand your cash flow, you know before it becomes a problem that you need to renegotiate those sorts of things. Do you need to be more aggressive with receivables? Do you need to be bugging your existing clients for them to pay you? Are they overdue? If you're past that 30-day window, between when you sent the invoice and when you get paid, and you still haven't been paid, well, every day that goes by, that money is less and less yours. Even though you did the work, you delivered the project, you did an awesome job with your project, you still might not get paid. The longer that goes, the less likely it is that you get paid. And does the scope of work that you're writing make sense? We know about your pipeline. We know that you're going to write the scope of work. Does the scope of work make sense? What does that mean? Well, what are the payment terms that you're outlining? When do you expect to get paid? How much do you expect to get paid? How is that going to feed into your cash flow forecast? How is that going to feed into your cash reserve? Same thing on the payable side. Are there payables that you're going to incur because of the way that scope is laid out? So maybe on the front end that you've got to hire a contractor or a designer or whatever it is, and you're going to have to pay them before you even get paid from the client. That's going to create a negative cash flow situation. How is that going to impact your overall cash flow from the business, and how is that going to impact your cash reserve? Is that going to put you in a spot that's really kind of tough? If that's the case, before you execute that scope of work, you need to renegotiate those terms. Figure out something else. Maybe get some cash on the front end that'll cover you, so it doesn't create this bad situation. But The whole thing is you need to be making decisions based on that cash flow forecast. Once you understand cash flow, money in, less money out, and the different buckets that it comes from, and understand the importance of cash flow from operations, and you're aggregating that data in a good accounting software, and then you're forecasting, and then you're making good decisions, that's where you want to be. Final thoughts. Cash flow often sounds complicated and scary, but it's really not. It's just cash in minus cash out. Where does your cash come from? Where does it go? You need to measure your cash conversion cycle. That's a good metric. I'm going to link here to an article by Investopedia that'll show you exactly how to do that. But it's basically, cash in minus cash out in days. So it'll tell you, when you spend money, when cash goes out the door, how efficiently do you turn that into cash in? And that'll be linked here. Understanding and measuring cash flow is important, but forecasting cash flow is even more important. You want to know when problems are going to happen before they actually do so that you can make adjustments going forward. And everything begins and ends with cash. If you run out of cash, the business goes out of business. At some point, people are going to stop loaning you money because you're not able to pay back the loans that you've already taken out, and you're not going to be able to pay your employees, and you're not going to be able to pay your mortgage. So everything begins and ends with cash. Those things need to be paid in cash. Hopefully, you're in a good cash position. Hopefully, your cash position is getting better and better over time, right? That's what we're looking for. Okay, resources for today's show. There's a marketing agency sample wayfinder. That's a really good tool as far as figuring out where you are and where you need to be and how you're going to get there. That's the roadmap. That's like our strategy session. As promised, there's a YouTube video that I did as far as what is cloud accounting and why is it awesome. That's a really good look at different accounting softwares and how you need to implement those and why specifically you need to be in the cloud. The cash reserve calculator, again, somewhere between 2 and 6 months, that calculator will basically just tell you exactly how much cash you should have in your business. What we call that is the Can You Sleep at Night Index. That's what we call it. And really, you need to be able to sleep at night. That's the whole thing. It's part of the reason why you need a cash reserve. There's a 1 hour long webinar here that I've linked here, Cash Flow 101. Everything cash flow related is in there, certainly a broader look than what I'm providing here in this video. Investopedia, the cash conversion cycle, again, that'll show you exactly how to calculate that. It's a great metric to use in your business. And then an ebook, Working Capital. Working capital is super important. Your cash is part of working capital. Working capital impacts how you're able to operate. It also impacts the valuation of your agency. So how much is your agency actually worth? If you don't have any working capital in your business, then when you go to sell it, you're going to have this kind of surprise because somebody has to come in and buy the business, one, and then on top of that, kick in extra working capital. It can impact, that's another topic for another show. It can certainly impact a lot of things, but that's a really great ebook. It's a great resource. Okay, wrapping up, let's connect. Chris@betterwaycpa.com. That is the email, 843-608-0298. That's the phone number. You can find me on Facebook, LinkedIn, Twitter, Quora, and Pinterest. If you like this video, please like it, please share it, please comment below. I would love to hear your thoughts on this. If this is content that you like, don't like, what you'd like to see in the future, it's super helpful. And always subscribe to the channel because then you'll get updates as far as videos that we're putting out and hopefully helpful, useful content. But that is it for me today. I certainly appreciate you watching, and I will see you next time.